Hello. How is it going? At least I didn't have my microphone off this time. Okay, so let me pull this out. That's probably better. I don't know how legible is that. Okay. Oh, that's it. What? $1. Oh, $1. Woo. Thank you very much. How's it going? Okay, hold on. What a shit show. This is like, you can't even trust me. Okay. Wow. Already got $1. Thank you very much. We will appreciate that. Greystone. Hello. We have a countdown. Yep. So, buying tomorrow. Oh my God. All right. Should get into it. Dan, you going to buy? I'm assuming you mean buy Reddit. Okay, let's look. So figure I'd cover. I looked over this when I had time yesterday. I wanted to just go over some of the nuts and bolts of the Reddit S1. It's like 600 pages. So if you're going to say I missed something, sue me. I'm not reading 600 pages. I just search for key terms to look for. So some things I would note about Reddit before it goes public, and you can decide if you want to buy this thing. All right. I use Reddit. Okay. But who cares? The question is, do I want to invest in it? Okay. So I was going to go over some parts that I thought were notable, and you can make your own decision. Okay. So I made some notes. Let me go through my notes. Okay. So basically, this is their plan. Okay. So they have users, right? So they have this is what they're selling you. They have a strong user base of commenters that are in the right demographics for advertisement. So their demographic is younger, typically skewing people. They provide a safe advertising space because they have really solid moderation policies and procedures. So advertisers can, wrap themselves in a blanket and feel safe and cozy advertising with them. Then we already knew this, right? This is the company as it's been forever. That business doesn't make money. Okay. So they need to, so you can see this pillar here, advertising. So their current business doesn't make money. I mean, so they have to sell us on the idea of, well, how are they going to get to profitability? So what they're going to do right now, their plan is to start selling their data to aggregators or AI companies or whoever, that they can train AI bots and stuff like that. They already have, I think they announced a $60 million deal with Google, which is kind of a drop in the bucket, but I guess it's a start. So the idea is they're going to sell that data, and then this data can be used in the future for the future AI economy. So this is what they're trying to sell you in this filing. Okay. So like, just to make a point, the current business as it stands is not profitable. So they, of course, they have to, like, something has to come about that would make Reddit profitable, in my opinion. I don't see how advertising alone would get them there. So this is what they're selling you on, AI. Shocker. I mean, you're all surprised. They're selling you on an AI future. Who would have thought? So, okay. So some things to keep in mind. So they go through like risks in these filings, cover every like defined risk, right? They have to put it in here. That's why it's 600 pages. So this is one risk, you could say, almost, which, you judge yourself. This business that Reddit has relies on free labor, which is kind of weird. So this business only works, mind you, it's unprofitable, but the only way this business even works at this point is that they have this army of moderators that work for free. Right. So I think you might have heard they're offering stock IPO options to 75,000 users up to, I think. So at least they're trying to benefit these people in some way. But this isn't that much different to me from like Instacart when they went public. They literally said, like the CEO said, Instacart went public because they wanted to provide stock incentives and ownership to the employees because they pay them such crap, honestly. So that was their motive for going public. For here though, it's a concern, right? So like they're selling you on this highly structured, moderated, safe space online. However, a risk is also these people they're relying on to provide this safe advertising community space. They don't pay them. They're volunteering their time. So it's a risk because they don't have to do it. They're not employees. And there's only so, how much control does Reddit have over these people? They are not employees, right? Moderators come and go. I was a moderator for, I'm not going to say what it was. It was a dividend related group, not anymore. So that's a risk of this business. So this kind of funny is I don't know why this is going nuts. Hold on me. Okay. Maybe you saw on Wall Street Bets. So Wall Street Bets, I think, got hold of this. So Wall Street Bets is a defined risk factor uh, in their prospectus. So they note in the filing. So they note in this thing that market prices and movement of Class A shares, which they're issuing, can be highly volatile and can be detached from the underlying business because of groups and popularity of right here Wall Street Bets among retail investors, direct access to retail investors, broadly trading platforms. So they're identifying that the stock could do crazy things because of Wall Street Bets could get hold of it and it could go loopy. So I'm pretty sure if you say that, they're going to do the opposite, but they put that in here. Okay. So they define, they're using this metric in their daily active unique users. So this is what they're going to probably put in their quarterlies to show growth and users. Because this isn't like a thing, you wouldn't like define like an account, right? Like an account doesn't have value in and of itself here, unlike something like Netflix or a Disney Plus. An account represents someone paying a monthly fee, so they don't have that here. So they're doing this daily active or unique users. So they're trying to show there's a growth trend here in the filing. It's kind of unimpressive to me, honestly. I think they just put this in here just because the last quarter they saw an uptick, maybe, but it's kind of flat. So I don't know. You'd have to believe they would have a way to uptick this, maybe, if this is what they're selling advertisers as far as what they're going to charge. So be it. Uh, I don't have a lot to say about some of these. Monetization. So they started selling advertisements in 2006. They're going to talk about have their own ad technology 2018. We believe we're in the early stages of monetizing our user base. Again, this is they have to sell this to us because currently it's not a profitable business. So we believe we're in the early stages of monetizing our user base, and we plan to expand our monetization efforts in a way that builds the core values of the platform. So again, they're trying to sell you that they're going to find new innovative ways to raise advertising revenue and use artificial intelligence to monetize their user base, so forth. All right. So this is something you'd have to understand and believe in if you want to invest in this. Okay. You can look here. Revenues up. So like I said, this is their the last quarter 23, 22. So they're showing you revenues up because you could see like the active user clicks were up, which means they probably got more revenue from advertising. Losses, they're still losing money. I don't, for my purposes, when people, well, they're trending, don't, I never have thought they're trending towards profitability. That's a dangerous thing to say because they could also trend away from profitability. So that's why I've said, like, let's wait till 2 straight quarters of profitability before we can start talking about that type of a business like Palantir, right? Prove themselves to me after 2 quarters straight of profitability, and it's done great. There's other companies that do 1 quarter profitable, and then they go right back into uncharted waters. So this doesn't really like tell me anything. I find this doesn't really help them. Where artificial intelligence. Yeah. So they're advertising and AI powered audience reach and bidding. We're using machine learning for contextual keyword audience reach and interest based audiences, ranking ads based on brand suitability. So again, you have to believe that they're going to have AI tools that are going to allow them to uh, better target for advertisers. Okay, a lot of companies are trying to do this right now. Data licensing, again, that's going to be a big selling point because this is something they could actually make real. Like this to me is more believable than the AI used to increase ad rev because they've got to sell that. It's not just you create AI and oh, advertisers are going to pay you more. Like they're going to have to create an AI tool and then they're going to have to like explain it to advertisers why they should pay more for this advertising. Like it's going to be tough. Beginning of the internet, companies had to explain how internet advertising worked and Google had to create that platform and it took I think like a decade. So we're in the early stages, like, so again, like it's not obvious, like they're going to have to go to these companies and explain why they should pay more for advertising in these certain situations. So data licensing is real cash they could generate, and I think Google's paying them like I said already. But how sustainable is that cash flow? They could just do this as a, just as like the hype of AI. These could be very temporary streams of cash for Reddit. And they don't have to renew these contracts if they don't want to. Ownership. So you can see here's the ownership structure as they identify. All these people are like executives and so forth that are going to get compensated. So one thing to keep in mind, there's three classifications of shares. So they have A, B, and C. Okay. They also have proxy instruments. I don't want to get into that. They have not issued any C, so we're not going to talk about it. So Class A is what you get offered. Public offering is what you have access to. You have no access to B. Class B is same economic benefits. However, you get 10 votes. You get the right 10 voting, whatever you want to call it. You get 10 votes for Class B shares and 1 vote per ownership stock of Class A. So you're not really going to get much of a say in how this is operating. It's going to be really tough to have any sort of activist activity like Nelson Peltz in this situation because the people here are going to own the vast majority of the voting rights, especially this guy, Steve Huffman, who I think is he the founder of Reddit, current CEO? So he has an enormous voting block with his B shares. So that's one thing to keep in mind. Now, the B shares, if they ever leave the company or want to sell or something, the B shares convert to A. They never, and then that's it. I don't think there's any provisions to like create more B shares. So these are like people that had interest in the company before it went public, and they're getting their rights. And some of it's not just people; it's also like this company here is getting B shares, Advanced Magazine Publisher. So they must be an early investor, this LLC, and so forth. The C shares are there are C shares in the initial offering of this document. They haven't issued any, they're not going to, but they can in the future, and there's no votes by shareholders. So they put it in here. If they want to issue the C shares that are in this document, they can, and there's no vote involved. So they kind of talk about it a bit, but again, since they're not issuing any, it's kind of light. Okay. So Class C shares, they kind of issue here. The Class C shares can be used for different purposes, financing, acquisition, investments, and so forth. But they're not issuing any right now. But it's in this. They don't have to get votes to approve it. They can just issue them if they want. So fun times. Voting rights. So here's the voting rights. Where is it? Okay, hold on. My note went away. I don't know where my note went. Voting rights. Okay. Yeah, each holder, Class A, 1 vote per share. B, you get 10 votes per share. Here's the initial offerings that they have in here. So 2 billion shares of A, 140 million of B, which you can't get. And so they're almost 50% of the voting right here. And you have no rights to that. So, and then like I said, they can at some point 100 million Class C shares. It's in their pocket to issue and do what they want with basically what they want to do with it. It's their decision. Of note, as far as their balance sheet, I mean, I don't know. Like I don't like to look at these filing statements. I hate this. I want to see publicly traded company filings. That's what I did with TKO. I don't care what they put in these really. I want to see after they start to operate as a public company because I think there is a difference when you start actually operating as a public company compared to this where they operated before in this private equity space. So you can look at these yourself and decide if you think anything's that interesting. They are sitting on a decent amount of cash. I'll give them that. They're sitting on like almost $500 million of cash. Long-term liabilities. I mean, you can judge yourself. There is we're a cash flow statement, stock-based compensation. So you can see they're issuing a pretty good chunk of shares in stock-based comp. So will this continue? We'll see. They're unprofitable. So you would think a lot of companies typically like that are using stock-based compensation to pay executives because they have cash flow issues, let's say maybe. So we'll see as this goes on. In general, like, do I buy companies that IPO or SPACs as they start up? I mean, no, I don't. I wait. I wait at least like 2-3 quarters before I can make a real decision. I want to see them operate as a real publicly traded company before I can make a decision. So these are just some things I've noted. They have convertible preferred stock is involved. They have all these different series. I mean, this is a lot to take in for a new filing. So these are all different series of convertible stock issuances that can be converted in the future. I don't want to read through it. It's really boring. So that's pretty much what I have to say. Basically, where we are with this is just the current business doesn't work. I don't think, in my opinion. I mean, the current business doesn't work. So you have to believe that they will be able to create value with artificial intelligence tools to increase advertising. Maybe they increase the user growth goes up, although I don't think it'll grow up that sizable if you're thinking double digit growth. Moderators need to keep working for free and they have to have some, hopefully they can monetize some of this data for AI training tools, which they got one contract already. So, I mean, to me, it's a no. I mean, for now, like I said, we'll wait 2-3 quarters and see. I don't really buy companies like this. I'll leave that to you. Like nothing's like red flagging about this. This is like a typical. There's a lot of companies that came out the last few years that look like Reddit, like software companies that don't make money, right? Like a lot of them are apps, though. This is not an app, which is kind of different. But um, some of them go bust. Some of them make it. Some of them fail as a public company, and then they go back to being in a private equity company like Rover. So, like I said, though, I'm comparing it to like an app, whereas this is this is not an app, right? It's different. And the moderators is different. And so we'll get to see the advertising value. That's what I'm curious. Like, will advertisers in the world where Elon runs Twitter X, where there's like advertisers are concerned about moderation of content because there really isn't any. So Reddit's now like, well, here I am. We have this army of moderators that moderate, and we have this great system in place that keeps crazies out and stuff like that. Is that valuable to advertisers? Like, we'll see. Um, let's see, bro. Okay. Wait, anybody say anything is substantial? I bet Reddit's going to give their mods C shares to have no say in votes. I don't. They basically they can do. There's like a whole paragraph, like I showed. They can pretty much do what they want. Like, just think the C shares are in their pocket, and they can use them at a later date. So they don't have to bring it to a vote or anything to do it because it's already in the filings. So we will see. I mean, if they use them they could use them for something good, I guess. All the share dilution, and we live more like that share structure. Oh yeah, we love it. I mean, it's not egregious. Like this isn't like crazy ownership structure like Dutch Bros. Like, but there's a lot of people that had stake in this company, right? And they all want to be compensated for their private equity stakes, and that's what this is. Um, I kind of like to let the mess go out, because, like I said, the B like as they progress, some of those B shares will start being converted to A, and then and eventually, given enough time, they're just going to have like one, maybe they'll probably just have the shares, the Class A's, years and years in the future. Uh, some BB buying IPOs is almost a bad idea because the investment banks have bad incentives to hype the stock. Any good value is taken by private deals before IPO. I A lot of these companies that I've read, they don't even say like they'll be like, why are you going public? And it's not like their first answer is not like to bring value to the company or to you know improve the share price to shareholders. Like they'll be like, we want to give incentives to employees, we want to you know buy, or we want to give like a cash buyout to like previous investors. Like they say all sorts of weird stuff. None of it's really what you want to hear. Like I don't want to hear that you're giving you want to give stock options to an equity investor of the past so that they can be compensated. I don't want to hear that. Like I don't want to be part of that. Good for them, but yeah, I think a lot of these get inflated. There's lots of parties that want to see the price inflated, right? I think, and if you look in this filing, like J.P. Morgan, Goldman Sachs, Merrill Lynch, Bank of America are all part of this offering. I think all the big banks are in this on like the first few pages. When is the IPO? I don't know when the actual IPO is, the actual date. I could look it up. Don't need to read financials, make predictions when you get the right people, internet warrior. Okay, so that's that. We'll close that down. Okay, hold on. Dang, where'd it go? All right, I was going to talk about. Ooh, we'll do this one next. Okay. Okay. Share. This made me laugh. I had to talk about this thing. So yeah. So Wendy's talked about surge pricing. Okay. Or okay, we'll cover. So this is what they actually said in the transcripts. So not the journalists. This is what was said. So beginning as this is the transcripts from the quarter from their earnings. Beginning as early as 2025, we will begin testing more enhanced features like dynamic pricing and day part offerings, along with AI enabled menu changes and suggestive selling. They also are going to put, I think, $20 million, yeah, right here, in a rollout of digital menus, because most Wendy's you go to have like the old rolling turnstile menus. The only ones that are like updated are the Wendy's that burn down, honestly, and then they rebuild them new in my area. So you can imagine like the whole crazy shitstorm that came down on them, because like this is absurd. Who's ever heard of this? You're going to change the pricing. So they're like, we're going to change the pricing based on customer, like orders and amount of people in the stores. So what, you're gonna raise prices for lunch traffic, and then you're going to lower prices in your off hours. That's what they were implying here. So of course, they get a bunch of hell for this because no one does this. Nobody's done this, and of course they reverse. Like, what a bunch of soft. I would not be, if I was owning Wendy's stock. I can't imagine why I would, but I would be so pissed. Like, what a bunch of softies. Like, if you're gonna freaking announce this in quarterly earnings and you can't stand a little bit of heat from the general public and you reverse immediately, freaking reversing on their surge policy, what a bunch of freaking shitty management. I'll say it, but that's weak. You announce this and then you backtrack immediately. Like, you should have just dug in your heels and say we're going to do it, or made no comments. So now they're in a weird spot. They look weak, and they already said they're not going to do it. Their first response was, it's not actually surge pricing what the news is saying. We said dynamic pricing, which, go on Investopedia. It's pretty like, surge pricing is dynamic pricing. It's all the same term. So that was a stupid response from them. Um, so the idea, I mean, I can understand like using maybe they use AI to this is so weird, but everyone's trying to figure out what to do with AI. This is like another example. Every company in America right now is like, we need to talk about AI. We need to have it in our filings. We need to announce some sort of AI tool usage for our business. Everybody's has, and then they have to after that figure out what the hell they're actually going to do to make money with it. So here's another one that does is doing this, like a freaking fast food chain. How is AI supposed to help you make any more money? Um, so far, what a terrible disaster Wendy's has done with this. Um, which mind you, I don't think McDonald's has said anything about AI. They're more interested in like robotics at this point, like automation of some of their store functions. So, but this couldn't have gone any worse. I mean, the digital board stuff, cool. I guess the idea is corporate can see what's being sold at each store, and then they could change the menus. Like they're gonna have to get into this more. And it's not such a foreign concept. Like there are different items, like at McDonald's, they don't like they've had special limited edition stuff in certain parts of the country, right? And then certain nations they have different food items. That's not that different. So they're talking about actually like varying prices. What a weird thing. And then they're like, somebody from Wendy's is like, well, you know, hotels do dynamic pricing, and what else does hotels, airlines, car rentals do dynamic pricing, right? It does change based on time of year and so forth. So they're like, why can't we? It's like, well, it's not. Is this really that hard? Like for a hotel, there are better times of year. I don't even know if I'd call it dynamic. I guess you could, but you know, there's more preferable times to go to certain parts of the world. So you're going to pay more. It's not the same as a burger joint. Your cheeseburger is the same whether you go there at noon or 4 o'clock. There's no perceived increase in value. So that's not the same as a hotel where, yeah, if you go to the beach in July in the Northeast, you're going to pay more because that's when everyone wants to go when it's warm. And if you want to go in freaking March, you're going to pay less because not so many people want to go, and you have less value because you're going when it's a colder, not so desirable time of year. So there is actually an increased value, which would kind of accept the increase in prices. Makes sense. If you want to save money on airlines, you can fly if you go look at plane tickets, if you want those morning flights out, you're going to pay more because they're convenient and there's, a time savings involved. Whereas if you have like flights maybe later in the day, they're cheaper because everyone's trying to fly in the morning. There is a value to that transaction that would make sense. Not the same as a burger. So this is just like, what a failure. This is why I'm glad I buy McDonald's or I own McDonald's stock, not this trash business. So have fun with that, Wendy's. So and they're pissed on Wendy's own Reddit, which people are not happy about this. Um like marketing Reddit. I love this one. How does out of touch garbage like this keep happening? I'm enjoying this. So this is from a marketing perspective. But yeah, this is a marketing disaster. And you really this is fast food, people. Like, how do you think that people are gonna feel like you go at noon and your burger's four and then or like $6 and then you go at 3 o'clock and it's $4? Like this is not accepted by society. Get out of here. I mean, and you can the whole fallacy, oh well, this business gets to do it. Why don't we? Okay, whatever. The internet didn't change their model. Why should AI? It'd be funny if there were 4 for 4, not $4. People find a new way to game the system and get that burger for 20. I mean, seriously, like people will go around. Like people don't underestimate people's ability to go around things like this. People will change their lunch breaks if they go to Wendy's for lunch. You damn right they're gonna go at like 2 or 3 o'clock if they know they can save a few bucks on a burger. People will do that. Totally. So yeah. I think this is so silly for them to even get into this idea. Um, But what a mistake. And then, of course, Elizabeth Warren can't, not comment about something like this because she's got to make everything sound like it's a catastrophe and it's the end of the world apocalypse. But Wendy's trying out surge pricing. That means you could pay more for lunch. Oh my God. Even if they cost the same, it's price gouging. It's not gouging. That's kind of a weird term. It's not really gouging, but it's American families have had enough. Yeah, because you represent America, don't you, Elizabeth Warren? Ugh, freaking, she's terrible. Terrible. And then I love this. Wendy's has issued a clarification. They never use the term surge pricing. Okay, like we said, they said dynamic pricing, not surge pricing. But go anywhere online, and surge pricing is the exact same as dynamic pricing. They're ubiquitously used anywhere online, Investopedia, whatever you want to look at. So that's kind of a random answer. So still not a good look from Wendy's. So, wait until Senator Warren learns about lunch specials and happy hours. So, all right. So we have a series. So we'll end with some memes on this one. So, I'd like to be true to fairly pay normal price, sir. This is Wendy's. I knew this one would have some good memes. Let's buy a house. Your maximum bid is $6.25 for your cheeseburger has not been accepted. What the fuck? Hilarious. And then I saw this from the Daily Mail talking about it. And then Frosty's 12 rubles, 60 rubles, 1,000 rubles. I must go. And then what else we got? What Wendy's thinks will happen during surge pricing. What will actually happen during surge pricing? Like in the world we live today, like do you really think people are like, I don't know. I don't know anybody that goes to Wendy's like for lunch break. Like unless you just drive by one and maybe you have no choice. Like most people in my area, like we have really good local restaurants. That's where so people either bring bag lunch or they do that. Some people go to not Chick-fil-A, Taco Bell sometimes. I don't know anybody that really like Wendy's every day. Ugh. So yeah, so they're trying to say that they were going to mimic Uber, but again, it's to me, it's like there is a perceived value attached to Uber's surge pricing. If you want to get a Uber car at Friday, like say for happy hour, you want to go out Friday. So do a lot of people. So there's more demand, but that is a perceived benefit to you. Whereas I don't see it as far as a restaurant. I think that was a weird take from them. I don't think it works. So pass on this. Hopefully they can not do this. I go to Wendy's like once every 4 or 5 months, I think. Worked at Wendy's as a teen. Their management is toxic as hell. All I gotta say. Yeah. This is we're gonna see a lot of companies that are just trying to slap AI into their business somehow. And this is what Wendy's thought would be a smart idea. So and it didn't turn out too well for them. So okay. One up. Hold on a second. So I was going to talk about this briefly. I did a post, but then I deleted it because it felt really braggy, and I don't know. I don't know how much I want to talk about winners. I was thinking about this because, like, I mean, you do sound like a jerk, kind of saying like, "Oh, I got it right," but I guess I could talk about some of the background because I've talked about I wanted to get into a housing investment. I wanted a housing investment that wasn't just about new construction, but also give me exposure to like wholesalers and remodeling, like so bigger scope. I didn't want to be like a very niche product necessarily. So the one I originally wanted to buy got bought out. The window company from the south. That's the one I really wanted. It was these friggin' really high strength and high tech, hurricane resistant windows and garage door company, but someone bought them because they saw its value. But what the thing with master brands is like, if you look at if you looked at this company, like I harp on everything money because it is a clown show, but if you had looked at this company just on their financials, you would have seen a big debt pile, and you would have probably freaked out. You would have looked at this huge debt pile they had based on this small, it's a smaller business. And you would have said, oh, you would have thrown it right out if you had just looked at straight financials. But what the financials wouldn't have told you, this debt was not caused by them just being like a crappy managed business that's losing money and taking debt out to buy shares or something like that. This debt was caused by them divesting from their parent company, and they took this loan out to give the parent company to become a separate company. So it's a different situation. They didn't cause this debt by running a crappy, unprofitable business. So just looking at the numbers, it would have deceived you if that's how you looked at this. If you did like an 8-pillar analysis as a screening tool, it's such a clown show. Like to screen companies based on something like that is just silly. It's really silly. There's other ways you could. I think PE is a good way to screen. That's what Peter Lynch would tell you. Just straight PE ratio. You could use that to start screening. And then a peer-to-peer evaluation could be a way you could screen for companies too. It's like, I want to buy, I'm looking for this type of company. You could then do a quick peer-to-peer analysis of like 5 or 6 different competitors and maybe go from there. But so that once I realized that, I could kind of build a story of this company. They were divested from their parent. Their parent was just this like conglomerate of household products. So it looked like they spun them off because they could get a big payment out of it so that they could go acquire other businesses, because that was their business wasn't running really highly efficient businesses or like companies. They were like just buying brands and selling brands type company. So I kind of understood what they did. And then this company had a plan where they were going to take all these little tiny manufacturing hubs that this cabinet company had, all these little tiny partial manufacturing places. They were going to close some of them. They were going to consolidate their manufacturing into a few key plants, and they would transfer some of it to Mexico. The story is not a revenue growth story. The story is a very cash flow positive company that took on debt to become free, increasing efficiency. So the margins should go up because they're increasing their profitability. And basically that's what happened when earnings came out. This earnings showed what I was thinking was going to happen. I think, I don't know exactly why this went up, but you can see earnings vertical lined right here. So when I looked at the transcripts and the financials, I can see. So basically they're telling you in this earnings, what I thought was going to happen is happening. They got way more efficient. So right here, let me see. No, that's not the one I wanted. Margin. I think it was this one. Okay, right here, you can see it. So gross profit margin increase of 440 basis points, 28 to 33. That's incredible. Now, if some of you are used to buying software companies and growth companies like that, you probably think, oh, that's not much. That's pathetic, man. 10% margin increase. This is an industrial, right? That's incredible for an industrial company, like right there. So like they're doing it. They're doing what they said, right? It's working. Um, they've closed down some plants. They've become more efficient. They had some one-time costs that they had to take last year. And then this was the other part that blew me away. So we have increasing margins. We also have SG&A going down. You want to see that? That's great. I don't want to get beyond. It doesn't have to go down. They're all just trending in the right direction. None of these by themselves are essential, but the story is playing out the way that they told it. Management said a story, the financials backed it up, and then they're executing. And I'm up like 20% now. So here it is. So it's interesting. This is the part I have fun with these days. Oh, let's see. Why not go for Agri or for I I have Agri. I like Joey. I think he's going to do fine. It's not a huge position in my Roth, but I'm not a fan of Realty Income. I just think they're too big. I think it's going to be tough for them to keep growing. Uh, so that's this. Other than that, they stopped. They were aggressively paying the debt back, and then they stopped this quarter. So I think they're kind of hinting that they're at kind of a comfortable leverage level right now, which is kind of similar to Crocs, right? You can't expect them to pay all the debt down. They don't need to. So it's same as you. Do you really need to pay everything in your life off like Dave Ramsey style? No, you just need to get to a comfortable level of debt, and then you can start doing things like vacations and maybe buy that treadmill you wanted and so forth. But you know, nobody go. I don't know, maybe some of you want to go Dave Ramsey. I don't really care, but you get to a acceptable, comfortable level of debt that you can manage. Companies are the same. So to say you want them to pay something off completely again, you're looking at every company through the eyes of a highly profitable tech company because those are the ones that have no debt, right? Talking about the Metas or the Googles and stuff. Like, yeah, of course, but that's a different type of business, right? And you can't apply that to everything, especially industrials. Industrials have debt, a lot of it, and you have to really pay attention because it's not the debt is important. Like, what kind of debt? Are they running a leasing company? Are they financing other acquisitions? The debt's important with industrials, really, really important. Because there's companies that can have a big debt amount on their balance sheet, and it looks terrifying, and it's just how the way they operate. Like Caterpillar probably has a lot of debt. I can't remember last. I haven't checked in a while, but okay, Caterpillar. Yeah, Caterpillar's got $24 billion of debt. That's the business they're in, all right? Like, they run a financing unit. They finance the heavy equipment to some degree, all right? So you'd have to dig in beyond just looking at the number. And if you did like 8 pillar garbage, like everything money, you miss out on amazing companies like this. This is an amazing company. So other than that, the excitement of cabinetry in America. So if housing and the tricky thing with housing investments right now, like the projections probably look terrible for a lot of these housing companies because housing hasn't picked up. Like, it's slightly turning the dial to better than last year right now. But they can't project, if housing were to boom because interest rates go down, they're like, how much are you think a company's going to project that at this point? Because we don't know. You don't know what the interest rates are going to do, and neither do they. So the projections can look really terrible on the housing companies this year. But I think there's some real good opportunities potentially. Some of them, though, a lot of them have already run up a lot. So that's why I looked at this because it hadn't run up, and then I could understand why it hadn't run up yet. But it's tricky. There's some really solid companies in this space like Simpson, Builder Source, some other good ones, and but they you got to be willing to accept their high valuations at this point. But the earnings could get pretty. They could grow really fast if given certain climates with housing. So we don't know, but that's the risk you take. Okay, last one. I'm trying to keep these to an hour. I feel bad when I don't want to ramble for like 2 3 hours. I feel like waste people's time. Uh, this is going to show that. So I thought this was like I know Peter Lynch. I don't really follow like super investors, so I thought this was I thought this was an outstanding podcast. I listened to it over like 4 or 5 days while I was at work. So I know Bill Ackman in general, but it's really cool to like the modern era we're in that you can listen to someone like this talk for 3 straight hours. Because when normally what do you see him on CNBC? He talks for 4 or 5 minutes before they cut him off for commercials. You don't get anything out of that. But like this was really cool to just to hear his process. And he talked about some really in detail investments that he had that worked out. And it's just interesting to hear like the process of someone like this, like how does it work? Like, how does he get those big hit investments? And his most successful investment was or I think he said this was his most successful investment was investing in Great Recession in I think it was a mall company that crashed because everyone thought it was going to go bankrupt. And he was explaining how he understood the bankruptcy laws, and then so that was able to give him confidence to invest in this company that everyone else just thought was going to go bankrupt. And then Lex is like, well, how did you understand the bankruptcy laws? Did you get an expert? He's like, no, I just read it. Like, he just got the bankruptcy codes and he just read the law. And he understood that this company could get through bankruptcy intact with equity without the shareholders being destroyed. And then he had to get calls from all his investors, harassing him about why he was in something like that was obviously going bankrupt. So just really cool to hear the process of how he got through this. And then they rely the reliance on expert network, which is I already knew that, but so like there's these networks of people that put themselves out there as an expert in some field, and then like people like Bill Ackman or other investors can call them and just ask them questions, like technical questions, which we have access to that too to some degree. If you're in a community of investors, you have an expert network, maybe depending on who's in the group. So you have similar tools to some degree. Not you're not going to have tools like him, but so I thought it was really cool. Like some of it was just really cool, just like how he looks for investments. One thing he noted, he kind of has like a Peter Lynch type where he stays in his zone. And he talked about it repeatedly. Like he has this core competency in like restaurants, and which you can look at what he owns. It makes sense. But he basically talks about like his core competency is understanding simple to understand systematic businesses like restaurants. And he invests in what he knows, which is probably a good lesson for retail people. He doesn't go buy things you don't understand, right? He's not buying Palantir. Like, you don't understand that. So he's sticking to what he knows. He's got his competency as an investor, and he's staying in his lane is how he talks about it. And it's just, I thought it was a cool, I don't know if anyone else listened to it, but I don't know if I can even play clips. I don't know if I'm going to is Lex going to attack me if I play a clip? But this one was a good clip. Well, I can always cut it out if they if I get, it's only like 4 minutes. I don't know, maybe he'll like attack me over this. Okay.
In your lecture on the basics of finance and investing, you mentioned a book, Intelligent Investor by Benjamin Graham, as being formative in your life. What key lesson do you take away from that book that informs your own investing?
Sure. Actually, it was the first investment book I read. And as such, it was kind of the inspiration for my career and a lot of my life. So important book. Bear in mind, this is sort of after the Great Depression. People lost confidence in investing in markets, World War II. And then he writes this book. It's for like the average man. And basically he says that you have to understand the difference between price and value, right? Price is what you pay. Value is what you get. And he said the stock market is here to serve you, right? And it's a bit like the neighbor that comes by every day and makes you an offer for your house. Makes you a stupid offer, you ignore it. Makes you a great offer, you can take it. And that's the stock market. And the key is to figure out what something's worth. And you have to kind of weigh it. He talked about the difference between, the stock market in the short term is a voting machine. It represents speculative interests, supply and demand of people in the short term. But in the long term, the stock market's a weighing machine. Speculation is it's a bit like trading crypto, right?
Strong words.
Well, short-term trading crypto. Maybe in the long run, there's intrinsic value. But the industry, understanding what management's going to do, understanding what price you're going to pay. The value of anything, I would say, other than love, let's say, is the present value of the cash you can take out of it over its life. Now, some people think about love that way, but it's not the right way to think about love. But it's so investing is about basically building a model of what this business is going to produce over its lifetime.
So how do you get to that? This idea of called value investing. How do you get to the value of a thing? Even like philosophically, value of anything really, but we can just talk about the things that are on the stock market.
Sure.
Companies.
The value of a security, the value is the present value of the cash you can take out of it over its life. So if you think about a bond, pays a 5% coupon interest rate. You get that, let's say every year or twice a year, split in half. And it's very predictable. And if it's a US government bond, you're going to get it. So that's a pretty easy thing to value. A stock is an interest in a business. It's like owning a piece of a company. And a business, a profitable one, is like a bond in that it generates these coupons or these earnings or cash flow, every year. The difference with a stock and a bond is that the bond, it's a contract. You know what you're going to get as long as they don't go bankrupt and default. With a stock, you have to make predictions about the business. How many widgets are going to sell this year? How many are going to sell next year? What are their costs going to be? How much of the money that they generate do they need to reinvest in the business to keep the business going? And that's more complicated. But what we do is we try to find businesses where, with a very high degree of confidence, we know what those cash flows are going to be for a very long time. And there are very few businesses that you can have a really high degree of certainty about. And as a result, many investments are speculations because it's really very difficult to predict the future. So what we do for a living, what I do for a living, is find those rare companies that you can kind of predict what they're going to look like over a very long period of time.
I thought that was an interesting clip. I don't want to play. You can watch it yourself. So I skipped all the stuff about the Harvard ordeal. I didn't really care. So you can skip if you watch it. His whole spiel about Harvard and the wokeness of them. But yeah, it was cool. I like how, he reads about the business, he looks at management, he's trying to build this idea of what this company's going to be. And I like how he sticks in his lane. So I enjoyed it. Whole pod is great. Just skip. Yeah. Really, like I think he talks about the Harvard stuff at the end. Yeah. So basically, up to 2 hours is finance, and then he gets into the Harvard stuff. The whole part about the Carl Icahn back and forth, I didn't know about Herbalife. So oh my God, I didn't realize that they literally were going at each other's throats over Herbalife because Ackman, I didn't know that. Ackman was shorting Herbalife, and then Icahn was like, F you, I'm gonna come in and buy a crap load of the stock. And then they had this backroom deal about what they were gonna do. So it was like two dudes at freaking with pistols at dawn. They were both trying to figure out what they could do. I'm like, this sounds like a freaking I think this was season 3 of the show Billions. Because I swear that was a storyline, right? That they stole that story for Billions. But it was funny to hear. So just his detail, and he covers his detail of how far he looks at these companies, trying to figure out where they're going to go. And it's harder for him because I can just buy something. I don't have to declare to the public. I don't have to scream from a rooftop that I'm buying something, right? And none of you do, but he has to. So while he's buying stuff, he has to keep filing and telling his investors what he's buying, and he has to do SEC filings. So he's not really keeping it quiet. So that makes it even more impressive, how well some of these people do, like he does, the way he thinks about cash flows, and his whole sticks to his lane about what type of investments he understands. The bankruptcy one that he talked about, I was like, holy shit, very impressive. And it's not like some secret. He just read the law and just understood it, where I guess no one else wanted to look into it. But so that was good. So that's it. Any other questions? So even more intense than most PMs. Yeah, Ackman, holy crap. So I should do a video on this. I've been thinking of a topic. So it's just how diversified does it make sense to be diversified for a portfolio? Because everyone always tells you should own, I always hear people say you should own 20, 30 stocks to be diversified. But I have papers, I should just go through them. But how many how many companies do you need to own to be diversified, which means that there's some sort of risk mitigation of that many holdings? And then how many does it realistically take to actually make a difference? So I have a few different papers I'm reading, but the short end of it, it's 10 companies will give you some benefit of being diversified. But another paper I have where they're to make a difference in your risk profile, you have to own 150 holdings and up, actually. So it's not 20, 30. But I think there's a lot of people just make shit up, honestly, about how diversified you should be. This is kind of a weird topic. It's more just how many, for retail, it's just how many companies can you hold and keep up to? I think is probably the bigger, how many companies you should own is like, well, how many can you read filings and keep up to date on? And the fact that you have some really good ETFs that you can take advantage of, and then you don't have to do that stuff. So counterpoint would be diversifying for the sake of diversifying. Then you will need to do research on them all, and then you'll have worse research on companies. Yeah. Because Ackman's just like, screw your diversification. He's like, I know how to invest. I'm comfortable. I own like 7 companies. Like, you like, and that's it. Like 10 kind of, I see that like 10 gives you some diversification. If you consider what if depending on how you define what diversification is for you, but it could be a good 15-minute video topic. I think some ETFs are too much diversifying. Well, yeah, because like what does diversifying bring you value? Like what does it actually matter? That'd be the first question. Like, does diversification even matter? Like what does that even do for you as an investor? And then how many stocks do you even need to own to have any sort of benefit of being diversified once you define it? Oh, Gil, you're prepping for your strong 5 would be great. I mean, if you're doing something like satellite core, like I've shown, like, you have like a broadly diversified fund, maybe you have some smaller ETFs of like certain industries, then it's just a matter of how many companies you want to speculate on. I don't think diversification even matters. It's not going to do anything in that case. It's crazy what his returns have been. Extremely underweight tech his whole career. I know. That's what kind of like, I'm like, wow, pretty impressive. Even though I hate to say this, but like, I'm the super investor that looks mostly like me is Bill and Melinda Gates. I hate to say it, but for a long time, that's who I've mostly identified as, just not the people running it. So, Dan, I've been prepping. I watched each debate and all points. I mean, I have my points against VT. Like my points are not against being globally diversified. I think my points would be, I would tell you to like argue VT not being globally diversified. But I don't know. Kingdom tried that. I'm gonna pick apart each of his points. Yeah, but you got to remember though, you can't be boring because it's YouTube. So you're gonna lose people if you go too far in the weeds with topics. You got to throw in some stupid jokes every once in a while. So far a good year. I did buy Palo Alto on the dip. I don't want to get into why too much because I'm not a tech investor, but I thought it was harsh, so got out of that. Crocs did well. I'm still in Crocs mostly. Disney's done okay. MasterBrand's up. So far, good year. Off to a good start. I don't know. I'd like to invest in some military companies, but I don't know. I will do a military episode. I think we should get the new DoD budget in a few weeks. So I was going to wait. I could have done the military episode now, but I'd like to get the DoD's budget and see where they're going to spend money. It's not a huge difference for me, but I'm probably going to exit my I have a position I might exit because it is so speculative. It kind of terrifies me to own it. So I could put a stop loss, I suppose. Smoke the weed, then debate. God, do we just suck it up and buy? Oh, okay. There's one more topic. I didn't want to put this on the cover because this is more for just me. I didn't even bring up a slide. Hold on. Let me pull. Give me 1 second. I don't know if you saw this. Okay. Did anybody see this week? So I have a New York State pension, so this matters to me. I didn't want to put it as a subject because I mean you probably none of you give a shit. But so the comptroller went on CNBC. I got to say he kind of looked like an ass. but he's not an investment dude. Okay. He's a good guy. Like Tom DiNapoli, he's a really good politician, and he's done well for the pension union. So I'm not being, I don't want to be totally an ass, but this wasn't a great look for him going on this show. So it is what it is. So basically they made news. They divested from Exxon, which was just bonds. It wasn't like the stocks. They were basically divesting from some bond exposure, and they were also limiting. They have 8 like petroleum companies. They're limiting limiting investments in them. And then here's the whole spiel, right? So this is what the pension is doing. Sustainable investing in the future is what they're trying to say. They're trying to say it's not because of politics. It's because of they're trying to make sure the portfolio, the New York State pension, is targeted towards sustainably growing investment opportunities, right? Which in the end, like if we just take politics out of it, it's like, do I really want the pension fund invested in guns and oil? I mean, not really. I'd rather them invest in interesting opportunities of the future. So like, if you take politics out of it, does anybody the whole argument, well, you're taking return from pensioners by not investing in things because of politics. Do you think oil is really the key to a good portfolio return these days? Oil or gun companies? And so, in the end, it's like, who cares? It doesn't look great. I will not deny that. But I mean, you can even look up what the New York State pension holds. I'll label this as like this part so people can just not watch this. But where is it? I probably can't. Oh, great. Is this the 13F? Yes, I am a human. God damn it. All right. I mean, so you can look at their holdings and yeah. So it's, can you see? I mean, Microsoft, Apple, Amazon, Nvidia. This looks like the S&P 500. It's probably weighted that way too, honestly. It looks about that way. Yeah. But their holdings are a lot of tech, Broadcom, Visa, Home Depot. I mean, whatever. So I think people make a big deal out of pension funds that pull out of things like this. But even if they had gun stocks in here, it would be like 0.001% if you did like a market cap weighted. It would be such a trivial, like, why even bother having the guns if there's such an insignificant amount in the portfolio? Who cares? And the oil, they still have oil investments like Chevron. So I don't know. I don't really care, but I will say like our pension's very well run. So it's one of the best funded in the country, which is important for me. It's 130 or 160 billion dollars. So it's a big pension fund. So whatever. Politics. I mean, politics are in this, but does it affect? No, doesn't matter. And he's, I'm kind of looking for, I mean, in my own life, I'm looking for climate change, decarbonization ideas because we're going that direction. So whatever. Yeah, pension funds are probably what? Yeah, there's a good amount of bonds in it. So I think they pulled like some of their Exxon bonds because Exxon pays really good, but they're going to stay out of that. Why am I so smart? So that's the show. I want to keep this to an hour. And yeah, maybe I'll do some more videos of just random topics. I got to learn to be more disciplined with like 10, 20 minutes. Not ramble forever. So thanks for watching. And everyone have a good weekend. It's hopefully gets warmer. Something. March Madness coming. Thank God. All right. Have a good day.